Alright, so you heard about the Fed tapering, you saw all the markets take a dump in the past few weeks, and probably you saw your crypto portfolio sliced in half in the past few days also. And now you're wondering, where is all this going to go? Is the Fed going to stop the printing machine? Is my crypto portfolio going to zero? Well, the quick answer is yes. No, I'm just kidding. But hey, it might go down a little deeper before we see the light at the end of the tunnel. So today, I'm going to tell you about the Fed, or the Federal Reserve, what it is, why it was created, and how it operates. And at the end, I'm going to give you my prediction, my humble prediction on macroeconomics and how I think the Fed's actions will impact the market. Hey there, my name is Hector, and if you're new around the channel, here we talk about things related to personal finance, from real estate, stock market, and cryptocurrencies. So if you're into that kind of stuff, consider subscribing and hit that bell notification to keep up with every video that I post in the tube. Alright, so let's talk about the Fed. The Fed was founded by an act of Congress in 1913. The Federal Reserve's primary purpose was to enhance the stability of the American banking system. Before the Federal Reserve was founded, the nation was plagued with a financial crisis. At times, this crisis led to panic, in which people raced to their banks to withdraw their deposits. The failure on one bank often had a domino effect in which customers at other banks rushed to withdraw funds from their own banks, even if those banks were not in danger of failing. Banks needed a source of emergency reserves to prevent panics and resulting runs from driving them out of business. A particularly severe panic in 1907 resulted in bank runs that almost collapsed the entire financial system and ultimately led Congress in 1913 to write the Federal Reserve Act. So the Federal Reserve is, for all intents and purposes, the central bank of the United States. And as every central bank, it regulates how much money floats around the US economy. In other words, the Fed controls the money supply. The Fed's purpose is to keep in check two main economic metrics: unemployment and inflation. Please keep this in mind. The Fed attempts to achieve this dual mandate through monetary policy, which is a series of tools that the Fed has on its disposal. Now, these are manipulating interest rates, reserve requirements, and open market operations. The Fed manipulates interest rates by regulating the discount rate. The discount rate is the interest rate that Federal Reserve banks charge when they make collateralized loans overnight to depository institutions. Not to be confused with federal fund rate, which is the rate that financial institutions charge to each other while borrowing money. This is important because by controlling this rate, they can control and adjust the end rate to the final customer. Remember, banks borrow money so they can lend it to other people. Obviously, they have to profit, so the lower they can borrow this money, the lower they're able to lend it to the final customer. So when the Fed lowers the discount rate, it creates cheap money. This makes it cheaper to borrow and less attractive to save, ideally leading to more spending, lending, investing, and the creation also of new businesses, which at the same time stimulate what? Exactly, stimulates employment, which are generally signs of a healthy economy. Those are good signs. But on the other hand, lower interest rates also tend to increase inflation, and this is generally a bad side effect. This happens because the total supply of goods and services is essentially finite in the short term, and with more dollars chasing the finite set of products, prices go up. The second tool is the reserve requirements. This is a minimum amount of cash or liquidity that a financial institution is required to have in comparison to specified deposit liabilities. By adjusting the reserve ratios applied to depository institutions, the Fed can effectively increase or decrease the amount of these facilities can lend. For example, if the reserve requirement is 5% and a bank receives a deposit of $500, this bank can lend out $475 of this deposit and is only required to hold 25 or 5%. If the reserve ratio increases, the bank is left with less money to lend out on each dollar deposited. The other major tool available to the Fed is open market operations, which involves the Fed buying or selling treasury bonds in an open market. The logic of this process is rather simple. If the Fed buys bonds in the open market, it increases the money supply in the economy by swapping out bonds in exchange for cash to the general public or financial institutions. Conversely, if the Fed sends out those bonds, it decreases the money supply by removing cash from the economy in exchange for these bonds. Therefore, open market operations have a direct effect on the money supply as well. Open market operations also affect interest rates because if the Fed buys bonds, prices are pushed higher and interest rates decrease. If the Fed sells out those bonds, it pushes prices down and rates increase. So open market operations have the same effect of lowering rates, increasing money supply, and raising rates, decreasing money supply. The real difference, however, is that open market operations is more of a fine-tuning tool because of the size of the US Treasury bond market is utterly vast. And open market operations can apply to bonds of all maturities to affect money supply. There's one more tool in the Fed's toolkit, and that sort of derives from open market operations, and that is QE, or quantitative easing. I'm pretty sure you've heard about this term before. So quantitative easing is a form of unconventional monetary policy in which the central bank purchases long-term government securities or other type of securities from the open market. At the same time, it greatly expands the central bank's balance sheet. When short-term interest rates are at or approaching zero, normal open market operations which target interest rates are no longer effective. Quantitative easing increases the money supply by purchasing assets with newly created bank reserves in order to provide banks with more liquidity. So this last tool, with a combination of fiscal policy, are arguably the biggest reasons why inflation has been so high in the past few months. Beginning under then President Donald Trump and continuing through President Joe Biden's administration, the Congress has approved some $4.5 trillion in total aid spending, according to the Treasury Department data. Last year, the Fed moved quickly to snatch up trillions of dollars in U.S. Treasuries and mortgage-backed securities to save the economy from basically collapsing into a full-blown financial crisis. Last year, the Fed added a lot of assets to its balance sheet. It was about $4 trillion before the pandemic, and now it's sitting at almost $9 trillion. That is a lot. That, plus the trillions of dollars handed over in the form of stimulus packages, has made this whole inflation situation a lot worse now. When the Fed buys these assets, they print the money they used to pay for these assets into existence. This injects new money into the economy, which again, in ideal circumstances, will stimulate the economy. But this stimulus doesn't come without a cost. Yes, it is again that stinky inflation situation. So as you can see, the theory is quite simple. The Fed utilizes these tools to keep unemployment and inflation in check. And they do this mostly by regulating interest rates and the money supply in the financial system. Easy peasy, right? If the economy is too sluggish, the Fed uses its tools to increase money supply, whether it is by lowering rates or injecting new money. The Fed makes savings less attractive and borrowing money cheaper, leading to investors to, borrow more money and increase their debt. And hopefully with that debt, that new money, they will create more business and generate more employment. As a side effect of that, we'll probably get a little inflation hike and maybe some investment assets or valuation, which could potentially lead to market bubbles. But then if the economy is running too hot, then the Fed reverses the process, hikes up the rate, sells out some bonds or their treasuries from their balance sheet, thereby reducing money supply and consequently cooling off the effects of inflation. Ideally, without affecting employment rates, and so we start all over. Well, in practice though, things tend to play out a little different. You see, The first problem with this approach is that lower interest rates and increasing money supply doesn't necessarily guarantee that the newly available money in circulation will be used to generate more employment. But on the flip side, increasing money supply and lowering interest rates are almost certain to inflate prices in the economy and raise the markets. This happened after the financial crisis in 2008. The Fed applied an aggressive monetary policy strategy to basically bail the financial system out of debt.
We often talk about the Federal Reserve using a bazooka to tackle markets and the economy. This is bazooka, cannons and tanks all at once.
Bringing interest rates down to near zero and utilizing QE, the Fed injected over $3 trillion into the economy by buying mortgage-backed securities from the banks. With the cost of borrowing money down to near zero, large companies started piling up cash in their balance sheets.
Valuations are generally elevated, especially corporate debt.
We have flagged the rise in corporate debt.
We have entirely too much corporate debt out there.
And this is where things took an unexpected turn. Instead of reinvesting that money into workforce and infrastructure, companies started to buy back their own stocks.
Buybacks.
Buying back stock.
Stock buybacks. Stock buybacks.
Yes, companies realized that the easiest way to make their company more profitable and valuable was to inflate their value of their own stock by buying it back. So now the Fed found itself in a vicious cycle where the tools that they had at hand to stimulate employment in the economy weren't necessarily doing what they were supposed to do. Instead, all that new injected money was being utilized to inflate the markets. Fast forward to 2019-2020, when the pandemic hit, millions of people lost their jobs. As companies struggled to stay afloat, the Fed had to step in once again and hit the gas on the money printer to inject liquidity into the companies that otherwise would face bankruptcy. This time around, though, there was more regulation, and the Fed forced those companies to use that newly injected money to pay employees. This would keep unemployment under control. Fortunately for the economy, the Fed's move worked. Unemployment levels today lay at around 3.9%, which is almost the same as pre-pandemic. But all the money printed and the fiscal stimulus didn't come without a price tag. And yet again, we are facing high levels of inflation. Inflation today is at almost 7%, which is the highest in over 3 decades. Also, as a side effect, once again, the stock market and other financial markets experienced one of the biggest seasons of overvaluation. This time, not because of the corporate buybacks, although I bet there was some of that too. But this time around, it was driven by retail investors. Yes, thanks to technology and all the extra cash laying around, people technically flooded the market with new cash. The stock market hit new all-time highs. Bitcoin went from $9,000 to almost $65,000 at its highest peak in 2021. So even though the Fed has admittedly succeeded at keeping unemployment under control, inflation has gone wild. And the financial market have honestly become addicted to easy monetary policy. This brings me to the second problem of this approach. And this is that financial systems and its different markets have become addicted to dovish monetary policy. By the way, the term dovish is said when the Fed promotes easy monetary policies and hawkish when the opposite is true. Anyways, after pumping so much money into the system, financial institutions, companies, especially those who have issued large amounts of debt, and retail investors begin to depend on the Fed's monetary policy and the ability to keep rates low. As a result, the financial system has become extremely fragile, so much so that a simple hint of changing monetary policy can easily break the stability of the entire financial system, bringing it to a collapse. A collapse in the financial system could signal the beginning of a recession, and a recession of a depression. And depression would bring slow or negative growth in the economy and therefore unemployment, thereby defeating one of the dual mandates of the Fed. Moreover, this time around, the damage to the economy could be exponentially worse, affecting directly the middle and low income class who's now directly exposed to these markets. And I know you relate to that because you're watching this video. So what is the Fed to do? Exactly. That brings me to the whole point of this video. The Fed is between a rock and a hard place. The markets have become so dependent on accommodating monetary policy that it's become almost impossible for the Fed to take the foot off the gas without causing a major crash in the financial markets. There are too many risks involved in stopping the money printer. But with inflation as high as it is, the Fed has no more options than raising rates, thereby sending the markets down for a ride. So my belief is that the Fed is going to at least try to hike up those rates, at least a couple of times this year, and will stop buying treasuries as long as the market allows it. But once Wall Street and the rest of the financial system starts pushing back and materializing their discontent in the form of unemployment and price instability, then the Fed will be forced to reapply accommodating monetary policy, which means, just to be clear, I'm not a financial advisor and this is just my opinion. I'm just a curious dude here on YouTube that cares for your financial education, so you make informed decisions and with your investment. So if you appreciate this type of content or learn something from this video, will you do me a favor and gently tap that like button? They say it helps. Also, consider subscribing to the channel and hit that bell notification so you get notified every time I post a new video. Well, I hope you enjoyed it. Bye.